Guys, you're welcome. And this video is a continuation of the topic we started last time. That's working capital management. Today, I would like us to look at some concepts that are very, very important in working capital management as a topic. We would like to look at what we call the operating cycle. I mentioned that the last time we met. So we want to briefly look at the operating cycle and the cash conversion cycle. We would like to see how it is calculated. It is very important. Operating cycle is very important because we did indicate the last time that the operating cycle is the length of time that a business would have to wait for the investment that is made in the working capital to be translated back into cash. Between the time a firm invests in working capital and when that cash is translated back to the business in a form of cash. Remember, a firm will use cash to acquire, say, raw materials. The raw materials will have to go through conversion. They will need time to keep the finished product to get somebody who is ready to buy it. Sometimes they sell it to the customer for a number of days before the customer comes back to settle, before they receive the cash and buy inventory again to convert. This is what we call, this is a cycle. And for a business that's a going concern, it becomes a continuum. And that's why we call it a cycle. It becomes an activity that a firm engages in regularly as long as the business exists. How long is the cycle? The length of the cycle will determine how much working capital should be made available to keep the business operating until the cycle ends for cash to be received again. Remember that if a firm invests in working capital and it will have to wait for some time before the cash comes back, let's ask ourselves a simple question. How does the firm maintains its business until that cash is realized? This is what every business would like to prevent, that you wouldn't want a situation where you have a shortage of cash or you have shortage of inventory, or where you have a situation where you have excess of cash or excess of inventory. Because remember, every resource that is kept idle, if you buy inventories that you don't need and you keep it for a very long time, you are incurring a lot of cost. You are increasing the cost, right? If you have a lot of inventory and you are not ready to use them, there is what we call holding cost, which eventually is going to increase the cost. Remember, in everything we're trying to do, we are trying to maximize profitability. And we did learn that profitability is a function of revenue and cost. The costs and profitability have negative relationship, as we have always been talking about. So any activity that is increasing the cost, remember, eventually it is going to reduce profitability. And so we would like to engage, we would like to prudently go through a process that will reduce whatever cost that we incur vis-a-vis the revenue so that we can maximize profitability. So that's all that we are trying to do with working capital management. And therefore, the time, the length of time that we use going through this cycle is very important so that we are able to determine exactly how much inventory, for example, exactly how much cash we will require to keep so our business can continue until we get those monies we have invested in working capital back. Remember, you have to pay your employees, you have to pay some creditors whose payments are due. And if you can't say that you haven't received the monies from customers and so you can't pay. Once creditors, the obligation is due for you to settle creditors, you have to do that. So let me go quickly to our slides and share my screen with you, so that we look at the issues. Right, so we're looking at working capital or operating cycle. Excuse me. Okay, so the working capital operating cycle, we're saying that it reflects the time interval between actual cash expenditures and the ultimate recovery of cash receipts from sales. So the time period when you buy, say, inventory, how long does it take for you to convert that raw materials into finished goods? It takes a number of days or weeks, depends on the nature of operations of the business in raw material conversion. How long does it take for the goods to be kept before you get customers to buy the product? How long, in terms of average number of days or weeks, do you give to your customers after you have sold to them on credit to come back to settle? This is what we are talking about, the interval between actual cash expenditure, that's when you spend in acquiring raw materials, and the ultimate recovery of cash when you receive the cash from, say, customers. It establishes the period of time required to convert a CD of cash disbursements back into a CD of cash inflow from firms' regular course of operations, and is also known as the operating cycle. So when we say working capital cycle, it is the same as the operating cycle. Great. So we have the short working capital cycle, as we saw the other time, and then the long working capital cycle. And this is a typical example or a demonstration of how the short working capital cycle looks like. Now, these are typical for many businesses that are into just buying and selling, right? So you go to a retail shop around Winneba Market or around or on the street, a retail shop on the street, and they are just buying just buying goods, finished products, and selling them as they are. So you go to a retail shop along the streets and they are selling rice. So they simply go and buy the rice and come and sell. Their cycle is very short. So in that case, you have cash. So you see the cash, and then it moves to acquisition or procuring the inventory. Then the inventory obviously is sold to customers, and then it comes back as cash. That is used to buy inventory again. It is sold. So we have, usually when we sell on credits, then we have receivables. Then we take time to receive the cash back again. So that is a very simple working capital cycle. And this is a very short one. Let's quickly look at the long one. So look at a typical working capital cycle, operating cycle. And this can be likened to a typical manufacturing firm. Okay, they have a factory. So we start from cash, we purchase raw materials. So the raw materials will take a number of days to be converted through the production process. Some production processes are very long. So you have what we call work in progress. If your production process takes about 3 days, 5 days, a week before you get a finished product, then you understand. So you get your finished goods, production process complete, and you have the finished product. Finished product sits at the finished goods warehouse for a number of days, where marketers and sales guys go out or wait for customers to come and buy. And usually, in a formalized business environment, we sell a lot on credit. Sometimes about 90% of sales are made through credit sales. So we will have receivables, obviously, when we sell on credit. So then we will have debt collection and credit payments, and then we will eventually realize the cash, and we will have to go through the cycle again. So you look at the arrows we have, the arrows linking each process is a demonstration of how long the period of time could be, the number of days or number of weeks or even months that activity is done. So when you add the number of days for each activity together, that will give you the operating cycle, right? I'm sure that is very clear. Great. So now, so the operating, let's look at these concepts. We are looking at operating cycle and then cash conversion cycle. We have indicated that the operating cycle is the full length from the purchase of raw materials with cash and then going through the production processes, converting it to finished goods, waiting for a while to get a customer, selling on credit and giving the customer a number of days to come back to pay cash. You receive the cash again and buy inventory. So that's the operating cycle. But sometimes, even though we have that length of time as our operating cycle, sometimes just as we give our customers some number of days to come back to settle, our creditors could also give us a number of days to settle our indebtedness with them when we buy from them on credit, right? Remember, we are talking about working capital. So we talk about the current assets and current liabilities. So current liabilities here, typically, we are talking about trade creditors, right? So just as you give a number of days to your customers, that is trade debtors, to come back to settle when you sell to them on credit, you can also negotiate with your suppliers, your creditors, to give you a number of days to also settle your obligation with them. Great. So the difference between operating cycle and cash conversion cycle is that the operating cycle is adjusted. The operating cycle is the full length. When the operating cycle is adjusted by what we call payables deferral period. The payables deferral period is the number of days, or let me say the length of time that creditors gives to a business to settle, right? It is a breathing, it's a breathing space, right? So if instead of paying on cash, buying inventories and pay on cash, your creditor says that, oh, we are giving you 10 days or 20 days to settle. So that's a period that you can relax to get the money back from your customers before you settle, right? So that should be used to adjust the operating cycle before we determine what we call the cash conversion cycle. So we will always determine the operating cycle, which is the full length of the operations, and then we adjust with the payables deferral period. When you take out the payables deferral period from the operating cycle, you obtain what we call cash conversion cycle. So operating cycle consists of 3 primary activities. Take note of that. And that is demonstrated on the cycle I showed in the earlier slides. So the operating cycle consists of purchasing of the resources, right? Purchasing of the resources, the length of time a firm uses to go through the process of purchasing the resources, right? Then producing the product. So we're talking about the conversion of the raw materials that is purchased and subsequently distributing of the product, that's the selling. So you purchase raw materials, the length of time a firm uses in the purchase of raw materials, add to the length of time it takes to convert the raw materials to finished goods, add that to the length of time it takes a firm to distribute, that is selling the product to customers. All that three period put together will give you the operating cycle. So the operating cycle is equal to the length of the inventory and receivables conversion period, right? We are going to look at the formula that is used to determine these, and it is quantitative. You need to work to get the figures. So it is real, it is not abstract. We will use the information we have in our financial statement to determine these lengths of time so that it can guide decisions moving forward as a going concern. So let's look at the operating cycle and how it is determined. The operating cycle is simply the inventory conversion period plus receivables conversion period. The inventory conversion period has to do with the period for purchasing raw materials and then the period for producing the product. So that is the inventory conversion period. We will look at the variables that are used to determine this. So when you add that period of inventory conversion and the period of receivables conversion, that gives you the length of time. That's the operating cycle. That is very important for decision making. Now let's continue with the operating cycle and then the cash conversion cycle. Now remember, we said that the operating cycle is made up of the inventory conversion period and the receivables conversion period. So let's look at how we can determine the inventory conversion period. That's the length of time required to produce and sell the product. And it is determined as the average inventory divided by the costs of goods sold times the 365 days. This 365 days is an assumption. It's an assumption here. The assumption is that we have 365 days in a year. In a particular question, the assumption could be that you may be told that assume that the number of days in a year is, let's say, 300 days. That's what you should use. So you always need to open your eyes and look at the information that will be given to you in a scenario. In this scenario, we are assuming that number of days in a year is 365 days. And we are looking for the average number of days that a firm uses to convert the raw materials to finished goods. So you are saying that it is average inventory divided by cost of goods sold. Average inventory divided by cost of goods sold. That is inventory conversion period. Great. So that will give you a certain number of days. Remember, if we use 365 days, whatever you get should be in days. Sometimes they will give you days in weeks. So for example, you may be told that assume that we have 52 weeks in a year. In that case, here you put 52 weeks, and that means that your answer will be in weeks. So take note of that. Now let's look at the receivables conversion period, which is the average length of time that it takes for a firm to collect monies from customers that they have sold to on credit. Now, receivables conversion period can also be termed as average collection period. It represents the length of time required to collect the sales receipts, and it is calculated as the average account receivables divided by credit sales. Average account receivables divided by credit sales. Please take note. We are talking about account receivables. So obviously we can only relate it to credit sales. In some questions, they will give you a figure representing sales, and they'll give you additional information to tell you the proportion of sales that's equivalent to credit sales. So you have to calculate that proportion and use it in the formula. In other questions, it will be silent. Whenever it is silent, whenever they don't talk about the proportion of credit sales in the total sales, you pick the whole total sales to represent the credit sales, you assume. Right, we're still looking at it in a number of days, and we are still assuming that the number of days in the year is 365 days, right? So if you get the length of time for inventory conversion period and then the receivables conversion period, put it together, and that gives you the operating cycle. Now, I told you that we want to move from operating cycle to cash conversion cycle, right? And the difference between the operating cycle and cash conversion cycle is simply the adjustment of the operating cycle with the payables deferral period, right? So the payables deferral period, I've told you, is the length of time or the period that suppliers will give to a firm to go back to settle their indebtedness. Okay, so the payables deferral period is the length of time the firm is able to defer payment on its various resource purchases, and it is given by this formula as average creditors. Remember, it's like an opposite to the receivables conversion period, right? But this is the payables deferral. So we're talking about creditors, how long creditors gives us. And just as we looked at the receivables conversion period, where we're relating the credit sales to the average debtors. Here too, we are looking at average creditors divided by the credit sales. Okay, so when you are given a scenario, you just need to go and find out what the average creditors are. And when we talk about average creditors, it means that in accounting, we know we have cutoff points. So if you take a financial statement, for example, you may be given information at the beginning, that's the opening balances, and you have information at the end, which will be in the balance sheet. So you compare, assuming that you had creditors at the beginning and creditors at close, you add the two and divide by 2, and that gives you the average. And you relate that to credit sales to find the payables deferral period. So eventually, our cash conversion cycle will represent the net time interval between the collection of cash received from sales and the cash payment for the company's various resources. So simply put, our cash conversion cycle is equal to the inventory conversion period plus receivables conversion period minus payables deferral period. I hope that is very clear. Let's look at an illustration, and that will make our understanding, that will make it very great for us to understand it clearly. So let me share my screen with you with an illustration. So just a moment, let me show you this illustration. Okay. So look at this illustration. Right, great. So let's look at this. So it should be determined. Determine the operating cycle and the cash conversion cycle with the following scenario. The financial statement of a CADU company, a distributor of fast-moving consumer goods, are shown below for the year ended 31st December 2020. So this is our income statement. So income statement for the year ended 31st December 2020, you have your sales revenue, so all the things you need to determine your net profits. This is a very common statement we are all aware of. So we have our purchases, we have our cost of sales, we have our closing inventory, so you have our gross profits, then the other expenses are here. They are sum up. It is deducted from the gross profit. So we have our net profit before tax to be 29. We have tax 7, so take it out from 29. So we have our net profit after tax of 22 cedis. Let's look at the statement of financial position. So in the statement of financial position, we have current assets. So the items are there. Then we have our non-current assets as well. Remember, what we are doing is about working capital management, and the operating cycle and cash conversion cycle determination is all based on the current assets and current liabilities, right? Most of the issues that we are looking at has to do with irregular trade trade activities. Okay, so we're talking about operations, we're talking about working capital. So in a normal operational processes, what do we require? Inventory, account receivables, accounts payables. These are the critical things that you require in our normal operations. So that is it. So we have additional information here that all purchases and sales are on credit. There has been no change in the level of um, debtors or creditors over the period. Calculate the length of the operating cycle and the cash conversion cycle for the business, and go on to suggest how the business may seek to reduce this period. Now, remember, one of the things you're trying to do here is to be able to reduce the cash conversion cycle, right? Now, remember that when the cash conversion cycle is long, what does that tells you is that um, you need to wait for that long period to get the cash you have invested back. And that will mean that within the period that you had to wait for you to convert or translate that investment you have made back into cash, you still need additional investment to keep your business surviving. And that means that you may go for additional sources of finance, which will bring you additional costs. And that eventually could affect the profitability. So what, as a prudent business person, what you will be aiming at is to try to reduce the cash conversion period. So that what it means is that you get your cash back as soon as possible, as soon as you invest. It doesn't take too long a time for you to get the money back. In that case, you don't actually go for, additional sources of finance to keep your business afloat until what you have invested comes back, right? You have, I'm sure you know, situations where businesses will have to go and arrange for overdraft, right, to pay salaries. They do that because sometimes the cash that they ought to receive from their customers hadn't come, and they still will have to keep their business going. So what they will do is that they will have to go to fall on their bankers, for example, to negotiate for a short-term credit facility to keep the business going, to pay certain or some immediate pressing expenses to keep their businesses going. And you wouldn't want to do that, because anytime you do that, you are adding to the cost and you are reducing profitability. And that is exactly what we want to avoid. That is why we are looking at how best to manage working capital so that we can reduce the cash conversion cycle. Very critical. So you are being asked a question here that calculate the length of operating cycle and the cash conversion cycle for a business, and go ahead to suggest how the business may seek to reduce this period, because that is very important if you're able to reduce the cash conversion cycle. So let's look at how this is calculated. The first thing, remember, we will have to determine the operating cycle. And we have said that the operating cycle is the sum of inventory conversion period and receivables conversion period. How do we determine that? So first, let's see how to calculate inventory conversion period, okay? And we have said that the inventory conversion period formula is the average inventory. So in this case, average inventory will be the opening stock. So go to the income statement, you will see the opening stock, right? Opening inventory. And then if you go to the balance sheet gives you balances of assets and liabilities at the end of the period. So in the balance sheet, you will see, as part of the current asset, you will see inventories. The inventories figure that you see in the balance sheet is always the closing balance of inventory. And the inventory figure you see in the, if you see inventory figure, the opening stock, so that is telling you the opening inventory. So since the formula is average inventory, we will add the opening inventory to the closing inventory. And because we want average, we divide it by 2. And so that gives us, that the numerator there gives us the average inventory. divided by the cost of sales. And remember, we want it in a number of days, so 365. So if you do this workings, you are getting 103 days. So what it means is that it takes 103 days to convert the inventories to finished goods. That's quite a long time. And that's more than 3 months, right? Well, it also depends on the nature of operations. There are certain businesses that are into manufacturing that it takes a very long time. Can you imagine how long it would take to build uh, something like, FPSO Kwame Nkrumah, right? The 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 ship that we use to extract oil from the sea, right? FPSO Kwame Nkrumah, for example, it took over 8 months to build it. Can you imagine if they are building a huge caterpillar, a huge machine? It may take, quite a long time. So sometimes it depends on the nature of business. But remember, in our preamble, our business is a fast-moving consumer product, right? Fast-moving consumer products like toothpaste, like soaps, right? Like cooking oil. If it is taking this long to convert raw materials, then we will have to investigate, right? So always look out for the nature of business, right? And that will help you to know whether the inventory conversion period is reasonable or not. Okay, then we also look at our receivables conversion period, and the formula we gave was the trade debtors divided by credit sales. Trade debtors divided by credit sales. Sometimes also the trade debtors, you could make it average trade debtors, assuming you had some opening trade debtors, you were given opening balance or trade debtors and closing balance or trade debtors. You add and it gives you the average. If you don't have it and they give you only the current year's balance sheet, you just pick the trade debtors balance and then you divide that by the credit sales, you multiply by the number of days in a year, 365, right? Our credit sales is given on the statement. If you go on the income statement, you see the credit sales. There is sales given in the income statement, and then down there, the additional information, we are told that all sales were on credit. So we pick that total sales on the income statement, and that can be used as the credit sales. Now, when we calculated that, 264 divided by 820, it gives us 118, right? 118 days. So our inventory, average inventory conversion period, 103, receivables conversion period 118. So it takes us, we give 118 days to our customers to come back to settle, right? So our full operating cycle is 103 days inventory conversion period and 118 days receivables conversion period. That gives us 221 days, right? So that is the full operating cycle. But if we want a cash conversion cycle, then we need to determine the payables deferral period and take it out of the operating cycle, and that will give us the cash conversion period. Now, back on our information, the financial statement, we can look out for the account payables. In this case, we have only balance sheet, one balance sheet for the current period. So you go there and look out for the current liabilities, you find the accounts payables, and that is 159, right? Divide that by the credit purchases. Credit purchases is indicated in the income statement, that is 568 cedis. Multiply that by 365 days, gives us 102. So even though our operating cycle is 221 days, our suppliers also give us 102 days to settle, right? That will give us some breathing space, right? So if you take the 102 days from 221 days, we are left with 119 days, and that is referred to as the cash conversion cycle, right? So this, I hope this makes it very clear, and that will bring the understanding. And let's go back to our slides and conclude. So remember that we were told to indicates how best we can reduce, the period. How can we reduce the cash conversion cycle? And this is very simple. We know the components that um, go into the determination of the cash conversion cycle. The components are inventory conversion period, the receivables conversion period, minus the payables deferral period. So in this case, if we want to reduce the cash conversion cycle, we know that as inventory conversion period and the receivables conversion period increase, they also increase the cash conversion period, right? In that case, if we want to reduce the cash conversion period, it's a matter of working to reduce the inventory conversion period and the receivables conversion period. Now we also know that the payables deferral period reduces the cash conversion cycle. So if we are told to suggest ways of reducing the cash conversion period, we can also focus on the payables deferral period and probably go to negotiate with our suppliers to reduce to increase the number of days they give us to settle our indebtedness with them. So please, I will urge you to go ahead and read more about it. It is not so difficult. So you can understand it with the illustration that we have seen. Take time to go through and make sure you understand. So how to reduce the cash conversion cycle is to reduce inventory conversion period, reduce receivables conversion period, increase the payables deferral period. But these are generic. I wanted to make time to read about how you can reduce inventory conversion period, how you can reduce receivables conversion period, and how you can work to increase the payables deferral period in a way that will not affect the business operations negatively, right? Somebody tries to reduce the inventory conversion period and it may have some negative consequences on the output, right? Perhaps good quality assurance policies may not be taken into consideration because we are trying to run fast to reduce the conversion period. We may close our eyes to certain quality assurance standards, and that can affect the business eventually negatively, right? So that's not what we want, but we want very legitimate ways of reducing the inventory conversion period. So read about that. Reducing receivables conversion period. Sometimes remember that if you reduce the receivables conversion period, it may be a disincentive to the buyers and they may not buy from you again. They may go to your competitor who is giving them, a long period of time to go back to settle. Now, increasing payables deferral period also, if you don't manage it well, you end up taking a long time to go back to settle the payables, and your suppliers may not be happy to sell to you on credit the next time. So even though we are working to do this, to be able to reduce our cash conversion cycle, it is also important, right, to acknowledge the fact that there are some negatives and we need to pay attention to them as we try to take this decision. I hope this encounter has been very useful. And I'm praying that you go ahead to read more about this. It is very interesting. Get more questions and solve them. And I'm sure you'll get it. Thank you very much for listening. See you later.